Hello, viewers. Thank you for joining us for this session where Mr. Anurag Bansal, Director SMC Global, is in conversation with the Chairman of Srei, Mr. Hermant Kanoria, about Srei being an NBFC standing strong for 30 years. The discussion will begin with the current Indian economic scenario and how NBFC responding to it.
As you have seen many phases or cycles of economy, what are your views on current state of Indian economy, and more particularly the role played by NBFCs in its growth?
See, NBFCs play a very important role in the financial sector and in supporting the economy because the banks, basically, they are generalists. They do almost everything in financing. Whereas NBFCs, they have carved out a niche for themselves and they are focused organizations, whether they are in car financing, consumer durable financing, micro financing, or they are in the financing of commercial vehicles, or companies like us, which have been in the financing of construction, mining equipments, healthcare equipments, or financing of infrastructure projects. So we are specialized institutions and we play a very important role. But every 5 to 6 years, there's something in the last 3 decades that we have witnessed that something happens either in the external environment which has an impact on the NBFCs, and there is a reverberation which is set up in the economy, which basically is caused either by certain actions which has happened in the economy or the NBFC sector itself. Like in the if I just very quickly take you through the journey, what we have witnessed in the last 3 decades is that with 94, 95, we saw that there were certain NBFCs which had failed, and there were very large NBFCs supported by groups like ITC, and they failed. And therefore, it caused CRB Financial, and they were large NBFCs which failed that particular time because their business models were not able to withstand the kind of businesses which they were doing and the risks which they were taking. Because financing is a business which is basically, as we say, that financing is a business which is for intelligent people because everyone wants money. Would you like to give money to, like today, if someone gives a small advertisement that there's money which is being given on loan, there will be a line from queue from here to the farthest airport because everyone wants money. But the assessment which the financial institution or an NBSC has to do is understand the risk,
Right.
the risk of the business which they are doing, the risk of the business of the client, and the client's capability of paying, client's intent of paying. Both are important. The client may have the intent, but may not have the capability, or the business may not have the capability, or the business environment would have changed. So you have to be absolutely on your toes on a continuous basis. And that is the business model of NBFCs, or whether it be the banks. The banks can withstand a lot of pressure because they mobilize deposits, and their cost of funding is much lower than what NBFCs are having. So therefore, the risks which NBFCs are taking are a little higher than the banks, but their capability to manage that risk is better than the banks because of their having specialization in the area which they're financing. So again, in 98, 99, there was a scam of Ketan Mehta scam, which Ketan Parekh scam, which was there in 98 to 2000. So again, there were reverberations. In 2008, we had the global financial crisis. So
Right.
therefore, I think that the intrinsic model of the NBFC itself needs to be robust, and that's what we have tried to do in the last 3 decades.
Excellent insight, Mr. Kanoria. Uh, Friends, India has seen lending book growth of 11% per annum in last 1 decade. NBFCs were clear winners against banks with lending book growth of approximately 18-20% per annum, which now has suddenly collapsed in last 1.5 years after ILFS episode. So, Mr. Kanoria, what are the lessons learned by NBFCs in present context? And also, please tell us how Srei has withstood this mayhem and has differentiated itself from others.
See, I think that one thing has been fundamental for us, and that has been that in the NBFC space, when we started 30 years back, a couple of our policies, which we have, which we have carved for ourselves right in the beginning, we still follow that as a discipline. So it's become like a religion for us. One, that on the liability side we take no risks. From the perspective, to elaborate it further, that we do not usually go, we do not go in for asset liability maturity mismatches. So we'll not borrow in the short term and lend medium to long term. So we try to see that our tenure is properly matched. Like ILFS and many companies faced a problem because they had borrowed huge amount of money in commercial paper. So we used the commercial paper money only for arbitrage, interest arbitrage, but we never used it for lending business. So therefore, the mismatches were not there. Second, we don't take uh, dominant risks in the interest rates. So therefore, on the liability side, if the interest rate increases, we pass on to the customer. If it decreases, we pass on to the customer. Then because we also borrow in the foreign exchange, so we don't take foreign exchange risks. So there could be foreign exchange fluctuations. So we don't take that risk. So these are the three risks. What we do is that we definitely take the credit risk on the asset side because that's the business that we are in. So whatever businesses that we understand, we take those particular risks. I would not say that in the last 30 years we have not made mistakes. We have also made mistakes in the sense that in the infra space, we were also carried away. In the early 2010-11, we were also carried away because the kind of growth which was happening in the infra space. So everyone was lending, and we being also an infrastructure lending institution and equipment financing institution. So we were lending in both the areas. So there have been lessons to be learned from that.
Okay, great. So, sir, Srei is in NBFC business focused on infra and equipment. Can you tell us something about the current business and how do you see the growth and what are different actions taken by Srei to tap the future opportunities and growth?
So basically, you see that it is very important to understand that in the NBFC sector, the market dynamics may change. And especially for companies like us who are in the infrastructure space. So we are doing infrastructure project financing, equipment financing. So we have two companies, infrastructure, Srei Infrastructure Finance and Infrastructure Equipment Finance. In 2014, we basically took a decision at our board after quite a lot of thinking through that infrastructure project financing is an area which is getting riskier. So therefore, it would be appropriate for us to gradually reduce our book. So in 2014, we used to have an infrastructure project finance book of almost about 28-30,000 crore, which we have gradually reduced to about 11-12,000 crore in the last 4-5 years. And we had also consciously decided in 2014 that we will keep on growing our equipment financing business because the risks are lower in that. And usually the equipment financing business in infra, we call it as an FMIG, fast moving infrastructure goods. So we have coined a new word for it. Like infrastructure project financing is medium to long term. So therefore equipment financing is usually short to medium term. So the financing tenure is between 24 months to 36 months. So it is much shorter. And you can realize your money. If something goes wrong, then you can take the equipment. And those are the skill sets as an organization that which we have developed. So we have developed that first of all, how to mitigate the risks while assessing the client, assessing his cash flow. Second is that in the event that there has been a problem with the client or with the environment, then what do we do afterwards? So repossession of the equipment, reselling of the equipment. So we have the whole value chain over a period of time which has been developed.
So anything on listing of Srei equipment?
Yeah, fortunately or unfortunately, I think September 7th, we had got the SEBI's approval, 2018, we had got the SEBI's approval for listing of Srei Equipment Finance, and we had appointed all the investment bankers, we completed our roadshow, we were just going into the market, and then just the week after that, the ILFS episode happened, and we had to hold on the issue. So, in a long journey of 3 decades, 1 or 2 quarters or 1 or 2 years is not that critical. It is important, nevertheless, but it is not, it is not resulting in the death of an organization. So you have to wait that time. Look at things which should be done internally to become more efficient, to rejig the business model, to tweak whatever is important to be tweaked. And that is what we have been doing for the last 15 months.
Perfect. Businesses, particularly NBFCs, run on capital, which is the main raw material, and this capital can be in the form of equity or debt. We have seen robust demand for debt papers from investors who are looking for opportunities to diversify their portfolio uh, and want to invest in NCDs of established long-term players. In fact, as we talk today, we see two NCDs are already open in the market uh, this uh, uh, this week. And so, what are your views on the NCDs market as such?
See, NCD is a good market, and basically the investors should look at companies which are established, which is very, very important. The businesses which the particular NBFC is in, then what has been the track record of that particular company in servicing their interest and their debt, the business model of that particular company, those things are important. And also, I think that it is very important. Like in the case of many of the AAA rated companies, also we have seen that how it has become in the default grade very fast. So therefore, it is always wise to spread your risks and not put all the eggs in one basket. So in NCD also, there will be different instruments with different ratings, and rating again is a perception of the people who are evaluating that. So at a particular moment of time, like today, people have become risk averse. So whether it be the rating institutions or it be the lenders, so everyone has become risk averse in this particular market, and that's what I was just reading a few days back, that the banks are sitting on 4 lakh crore of liquidity, and so therefore there must be a negative carry, I presume, on that. But still, they are sitting on liquidity, which is a reflection of the scare which is there in investing or lending.
Correct, sir. So, in last few roadshows, we have heard the term co-lending. Can you elaborate on that a little, please?
So basically, at Shrey, what has been very important for us to see that how do we mitigate our risks on the asset side on an ongoing basis, and also liquidity is important. So how do we raise money? Because for us, we are in the business of lending. In the business of lending, the raw material for us is money. With co-lending, which was introduced by RBI last February, the model which was introduced, so we found that it was a very effective model where we do not compromise on the business, we do not compromise on the quality of the business, but at the same time, we are in a position to share the risk in the co-lending with the banks directly. So earlier, before the co-lending which was introduced, so all the risks were taken on our balance sheet.
Okay. So, I have Mr. Abhijit Sharma from IFL Securities, Bangalore, and Mr. Avinash from IFA, who is IFA in Pune. They have asked regarding current debt equity ratio and NPA level, and how do you plan to reduce the NPA levels?
So basically, the NPLs have been on a continuous decline, but at the same time, the provisioning norms
Okay.
have been changing.
All right.
So we have introduced India's from last year onwards, plus with the RBI also, because everyone sees that in this particular environment the risks are much higher. So the regulator and also from the accounting norms, everyone insists on making a higher provision because everyone wants to play on a safer side today.
All right.
So when we make these provisions, it's not that we will not be in a position to realize the money, because our capability is not only in lending but realizing the money, and we have demonstrated it not once but time and again. With Kingfisher is one of the examples, but besides that there have been so many examples of companies who may not have been paying to the others but who have been able to pay to us, because our loans are well secured, are well ring fenced. We When we lend, we do a risk mitigation which is more, it may take a little time. So therefore we do have to make provisions and in compliance to the regulators requirements and to the auditors desires. So we have to do as per the accounting norms, but this is not something to get. So the NPL keeps on going up and down, but that is nothing which people should get scared about it, because whatever financing that we do, one thing is very clear, that we are not doing consumer financing.
Right.
We are not doing cards, etc. Where when you realize an asset, so everything that we do is a productive asset.
Okay.
Construction, mining, healthcare equipment is productive asset. And when we have financed it, when we have to repossess and resell, we are able to get a value. When we do project financing also, these are against those particular projects where there may be some lag in the cash flows. And that is the reason why we make a provision. But giving you an example, let's suppose that we have financed a road project. There may be a lag in there having the toll collection to the extent that it was expected. But the road project is for 15, 20 years, 25 years. But unfortunately, our provisioning norms are that if the client is not able to pay in one quarter, then you have to make a provision for that. So there may be a catch up in the next quarter or the third quarter. The project does not go down the drain. So here is in consumer finance. So unfortunately, the guidelines that we have today, whether it be the accounting guidelines or the regulatory guidelines, do not segregate between the provisioning norms which is required for consumer financing and financing against productive assets.
I hope that answers IFL Securities question. So we have a consequential question from Manu Padaya, iFin Limited. He has asked regarding rating downgrade and is there any major implication? And they have also asked about the asset liability mismatch, if any.
So basically on the asset liability mismatch, as we had elaborated, that we do not borrow short term, right, to lend medium to long. So that we are very cognizant about it, and this has been fundamentally ingrained in the organization. So therefore we do not, and it's like a religion for us that we do not do any violations of it. Definitely on the downgradation side, the rating institutions after the ILFS episode, and then there were a couple of more housing finance companies which we have seen certain problems. So therefore, the rating institutions have also become a little bit, I would say, that apprehensive about how the market is going to span out. So we have seen these ratings coming down and up for the last 30 years. As I mentioned, that we have weathered many storms. We have seen a lot of ups and downs. We have seen rating upgrades and downgrades. But the company continues because the fundamental business model for us is robust and it's medium to long term.
Well answered. Uh, so another question I have is from Uday Kopalkar, IFL Securities Bangalore, and Mr. Satyabrata Mahapatra, Stoke Holding, Kolkata. They have asked regarding growth going forward. Though you have answered the question earlier, do you want to add something?
I think that growth in the equipment financing business will always be good. Unfortunately, last 15 months, because of the market situation, we took a conscious call that we will slow down the financing. And because of our slowing down the financing, the sale of construction mining equipment last year declined by 30%. So that is the impact which it has caused, because we have a 30-35% market share and it's a substantial market share. So when we decided to slow down, so gradually we have started picking up again, because we had to make sure that the funding was available on an ongoing basis, and we did not want to so for us there are two sides of liquidity. One is meeting the present liabilities where there is no problem, but on an ongoing basis we must see that on an ongoing basis there is sufficient fund availability which is there in the domestic market from the banks, and as we know that the banks have shied away. So therefore the other market is the NCD, which is also muted.
Yes.
So the third market for us was ECBs and ECA, so which has still been very good for us. So we have been raising money in the ECB market on an ongoing basis, and because on the liability side we had a diversified product mix, so therefore we had no concentration that if this does not come in, if one product is not sellable, that means that we will not be able to raise resources. So what we have done is that we have tried to moderate our growth, but with this co-lending which is developed now, so we hope that we will be back to the earlier growth rates which were there. But we will be cautious because at present the way that we see the economy, the way we see the investments which is happening in the infrastructure sector, so it will not be prudent for us if we go aggressive.
All right, well answered, sir. So one last question from my side. Do you want to offer any comments on the share price?
See, share prices, fortunately or unfortunately, as a family, I would say fortunately, few years back, almost about 5-6 years back, we decided that all the shares are held by our trust. So there is no tearing hurry for the share, for the trust to either sell the shares or buy the shares, because we do not go in for any kind of market operations. We are confident, and as management, as people who are in the business, we are totally committed to the company. And that is why we focus on the business. We do not focus on the share market. The share market basically moves on the basis of whatever is happening in the market. The news which is there, sometimes good news, sometimes bad news. People in the people feel that NBFCs as it is are strained. People feel that infrastructure is having a problem. People feel that all the construction companies are having problem. So therefore, we should also be having a problem. But fortunately for us, we have seen this for the last 30 years. So therefore, we know when the markets slow down, what kind of a behavioral pattern for the business that we should have. So therefore, we are quite confident about our business model. We are quite confident about what we are doing in the business. So therefore, the share prices will bounce back again when the investors get the confidence that we have come out of this, the present environment. But from the company's perspective, I think that there has been no change, and we are absolutely in a good shape. There is no problem.
Right. Balanced answer. So here we come to the close. Thank you, Mr. Kanoria, for giving time, facing my questions and distributors' questions, connecting with the distributor family, and sharing your views on Indian economy, Srei business, NCD market, and addressing, all of us. I'm sure that the interaction today is benefiting all the community. Thank you very much.
Thank you very much. Thank you. This was very interesting, and I would like to once again thank all of you for supporting Shrey and for supporting our NCD issuance and the bond issuance on an ongoing basis. We can assure you, and also we would request you to assure the investors that whatever may be the prices in the secondary market for the NCD and bond, because that we do not have any control on it, but we can basically assure everyone that all our payments are timely, whether it be on interest or on the principal of the bonds, and people should not get worried about it, because we know that we are acting as custodians, and therefore we are very well aware about our responsibility, and we would not let anyone down. Thank you.
Thank you, sir.
Thanks.
We hope that this chat session was quite informative and hope your queries were addressed well. To know more or put your queries, please feel free to get in touch with us at connect@sreibonds.com. Visit our website www.sreibonds.com. Thank you for joining us and wish you a great year ahead.